Have you seen the latest numbers? Interest rates on certain investments have dropped from a high of 18% to a low of 10%. What does that mean for your portfolio? And most of all, how do you respond to this? Today, I'll be explaining why this is happening and how you can smartly adjust your strategy without falling into the trap of panic selling. Stay tuned. Hi everyone, welcome to my channel. My name is Miss Wangui Mwithathi, and here we talk about smart money strategies, investments, and stuff that will help you grow wealth. So if you're new here, make sure to like, subscribe, and turn on that notification bell for more tips on investing and, of course, personal finance. Today, we are looking at a major shift. Interest rates are falling from 18% to 10%, and some even less than 10%. I'll break down what's behind this change, why panic selling is dangerous, and how diversifying or shifting your funds can help you lock higher returns even in a down market. Let's begin by understanding why these interest rates are dropping. You see, interest rates on investments can fluctuate for many reasons, okay? Some of these reasons can be central bank policies, changes in market conditions, or even economic global slowdowns. Recently, we've seen a trend where yields once were giving an 18% interest rate and are now closer to or around 10%, some 9%. This shift can be due to factors like lower inflation expectations, maybe some adjustments in monetary policies, or increased market competition among funds. So you see, understanding these factors is very important because it helps you know that this is not just a temporary glitch. It is a part of a broader economic shift. And in this kind of environment, reacting emotionally by panic selling or withdrawing your money, pulling out your funds, can lock in losses for you instead of preserving wealth. So let's discuss what's panic selling and why you should avoid it at all costs. Panic selling comes with its dangers. Let's define panic selling. This is where you, the investor, sell off your assets in a hurry or withdraw your funds in a hurry based on fear. You pull out your funds because you've panicked. So if you had invested somewhere, you go and withdraw your funds. And mostly when this happens, it oftenly happens at a loss. In our current environment, if you sell when rates drop, you might lock in those lower returns, or even worse, realize a loss on your investments. Remember, reacting impulsively often means missing out on the market's eventual recovery. So instead of selling in a panic, consider the long-term implications and the power of compounding if you stay invested. Okay? Let's talk about strategies to navigate this situation. Some of the smart strategies are: 1. Diversification. Diversification is one of the key strategies when it comes to managing risk. By spreading your investments across different asset classes and funds, you are not overly exposed to a single rate environment. Okay? When one sector sees rates drop, another one might offer a more effective return. And this kind of balance will help you stabilize your overall portfolio. Okay? 2. Shifting between funds. And this is where, like, if you notice that a certain fund is consistently offering lower returns as interest rates drop, it might be wise for you to shift your investments to a fund or to funds that are more likely to maintain higher yields. Okay? There's always that option. And this could mean rebalancing your portfolio or moving from one type of investment vehicle to another, always with a long-term strategy in mind. Look for funds with robust performance histories, one with strong management teams, and those that are positioned to take advantage of market changes. You see, sometimes actively managing your portfolio rather than letting it sit passively can help you, the investor, secure better returns. But with all that being said, you still need to stay informed. Always keep an eye on market trends and interest rates forecasts. Do a regular review on your portfolio and be willing to make strategic shifts that will protect your wealth over time. Sometimes you have to do what you have to do, okay? While it might be alarming to see investment interest rates drop, the key here is to avoid panic selling, okay? If you had invested in something like shares, stocks and shares, don't be so quick to sell, okay? If you had invested in something like a money market fund, don't be so quick to withdraw your money. So, apparently, actually, there's people who invest when the markets are low and then they wait for the markets to go back up and then now they can withdraw their profits. So instead of panic selling, consider diversifying your investments and strategically shifting between funds to lock in higher returns where possible. Always keep a long-term perspective and let your financial literacy guide your decisions. So you need to be well informed. If you're not financially literate, that can be a slight problem for you. And this is why, like my last video, I talked about some of the books you need to go and read. So go check that video out. And if you're not financially literate, you can use YouTube. There's online courses. Just be hungry for knowledge, okay? Go learn. It's not that difficult. All you need to do is decide, make up your mind, okay? Be financially literate. And that's how you'll be able to make better decisions when it comes to money, okay? And when you're investing, this is about finances. You need to be in a better position to make better choices. So, I hope this gets to help someone. But in the meantime, what strategies have you used to manage rate changes in your investments? Share with us on the comment section. Well, that's it for us today. If you'd like to see more videos like this, don't forget to like and subscribe, and you'll be notified once we upload another new video. Thank you so much for watching, and see you next time.